The entire housing market is on the verge of collapsing. That may appear to be a bold claim, but it is supported by irrefutable evidence. Almost every housing indicator is flashing warning signs. There are record low mortgage applications, skyrocketing evictions, low consumer confidence, bankruptcy, and a housing bubble. The housing market was built on the sand pillars, and all of them are about to collapse. Within the next 12 months, the world will witness the complete collapse of the housing market. Hello and welcome back to Finance Insights. At the end of this video, we will cover exactly which cities will experience the most pain from the impending housing crisis. So make sure to watch the video all the way through. Let's get started. According to the National Association of Home Builders, the US is already in a housing recession. Because of the massive increase in home prices over the last decade, home construction has taken off in a bubble-like fashion. The number of privately owned houses under construction has reached an all-time high. That's right, a new high. Over 1.6 million housing units are under construction, which is 12.5% more than during the housing bubble of 2008. Hundreds of thousands of houses will be put up for sale in the coming months, and there will be no buyers. Housing sales are currently declining month after month. Sales of new single-family homes have fallen to a 5-year low of only 500 million units per year. Not only do we have a record supply, but also shrinking demand. Consumer confidence is extremely low. According to surveys conducted across the country, Fannie Mae's National Housing Market Survey best exemplifies the horrifying consumer sentiment. According to the survey, 79% of the US citizens believe that now is not the good time to buy a home. On the other hand, only 17% of the citizens believe now is a good time to buy a home. When everyone believes that the housing market is about to collapse, prices will inevitably fall. Mortgage applications are now at an all-time low. Mortgage demand has dropped to its lowest level in 22 years. According to Mortgage Bankers Association, rising interest rates are one of the primary causes of low consumer confidence. Jerome Powell, the chairman of the Federal Reserve, recently stated that the interest rates must be raised at all costs. Higher interest rates, slower growth, and softer labor market conditions will reduce inflation, but they will also cause some pain for households and businesses. These are the unintended consequences of lowering inflation. Powell will keep raising interest rates regardless of how badly the US economy suffers. Because of capitalization rates, this will topple the housing market's pillar. Institutions flocked to the housing market to create investment products over the last decade. Firms such as Blackstone have entered the real estate market with billions of dollars in a new housing acquisitions capitalization rates, or cap rates in short, are the primary reason why institutions are flocking to housing. Cap rates are calculated by taking a property rental income and dividing it by the property's market value. The cap rate is 4% if a house is worth $1 million and the rental income is $40,000 per year. Powell is adamant about raising interest rates to 4% by 2023, putting enormous pressure on the rental market. In the future, as interest rates rise, real estate investors' profit margins will be significantly reduced. This difference, also known as the spread, represents the additional profit made by the real estate investors from properties. If the 10-year Treasury yields exceed the cap rate, there is no reason for investors to invest in real estate. This is due to the fact that purchasing 10-year Treasury bonds is as simple as pressing a button on your iPhone. In the past, the spread was quite profitable. With landlords making a tighter profit on their properties, the 10-year Treasury yields is now about 3% and is expecting to rise to 4, 5, or even 6%. As a result, real estate investors will make less profit on their properties and may even lose money. Because real estate prices have risen so dramatically, many real estate investors begin to use adjustable rate mortgages. This will have disastrous consequences. Adjustable rate mortgages, or ARMs or ARMs for short, have interest rates that fluctuate with the market. Because of the high real estate prices, the use of ARMs has increased significantly over the last decade. When interest rates are low, ARMs perform exceptionally well. Interest rates are now expected to jump to 4% by 2023, putting those who took out ARMs in serious trouble. Many investors will be forced to sell their properties. This is due to the fact that as interest rates on ARMs rise in the coming months, some citizens will be unable to pay the increased interest. If a house owner fails to make their mortgage payments for 12 months, the house will be foreclosed. A foreclosure occurs when a lender takes possession of a home in order to sell it and recoup their loan. Foreclosures are up to 100% year over year, and this is only the beginning of a much larger trend. With interest rates starting to rise, foreclosures are bound to skyrocket in the future. While foreclosures are a serious concern, there is an even more serious issue: evictions. Eviction filings are currently on the rise due to the two major pain points. Landlords are currently evicting tenants in large numbers. The first reason is that the United States government prohibited evictions during the pandemic. During the pandemic, laws such as the COVID-19 Tenant Relief Act prohibited landlords from evicting tenants. The US Treasury Department also contributed over $46 billion to help tenants pay their rents. During the pandemic, all the government assistance prevented evictions. The majority of these programs have now ended, resulting in an increase in eviction filings. The second reason for the increase in evictions is that rental prices are simply too high. Landlords had to significantly raise rental prices due to housing price inflation. Rent-to-income ratios have risen to a 10-year high of more than 23%. This means that the average American spends more than 23% of their income on housing. This is extremely high, and it has recently forced many people to become homeless. Institutional investors are now exiting the rental market by evicting tenants and selling their properties. According to the reports, over 123,000 families have been evicted by the private equity firms and other corporate landlords across the country. Because cap rates are currently declining, institutional investors are forced to sell their properties. This will have serious consequences for housing prices. However, there is a much larger elephant in the room: banks. Banks are losing money because mortgage demand is at all-time low, and tenants are not paying their rent. With mortgage applications continuing to fall, it would not be surprising if banks begin to lose money soon. Wells Fargo, JP Morgan Chase, Bank of America, and Citibank all saw their profits fall by 20 to 50% in the most recent quarter. Because of their large market share, the four banks are also known as the Big Four. The combined value of all these four bank assets is nearly $9 trillion, or roughly 45% of the total US GDP. The Big Four have unfathomable power over the American economy. While forecasts for the housing market differ from person to person, most banks anticipate a crisis. According to Goldman Sachs, housing activity will fall by double digits in 2020 and 2023. With a final score of 53 out of 70, we believe the housing market will fall much further. Because of the wealth effect, the housing crisis has far-reaching consequences. The wealth effect is an economic phenomenon that occurs when your personal net worth increases, which increases your consumer spending. The wealth effect also has an inverse effect. If your net worth suddenly drops, you will most likely spending less money. The impending housing crisis will have a significant impact on the entire US economy due to the wealth effect. The top 20 overpriced cities are currently displayed on the screen. What is the state of the real estate in your country, or if you are in the US, how is it in your state? Do let us know in the comment section below. If you enjoyed this video, make sure to hit the like button and subscribe to stay up to the date on the economy. Thank you for all your support, and I'll see you in the next one.